Hi, how's it going? Welcome to this live session of the Stock Market Q and AMP. Stock Market Q and AMP, a number 8. It's a staple in our lineup. On Saturdays, Sundays, you have the Sanhedrin, and on Thursdays, the Stock Market Q and AMP, A. Albert Milana Alvar. How's it going? How are you?
How's it going, Antonio? I am getting used to seeing you without glasses.
I have to get used to it myself. I still reach for them on my nightstand and think, damn, but yeah, little by little, honestly, it's going well. Well, as you already know how the Q and AMP works. In fact, there are already a ton of questions, but before we start with the Q and AMP, let's remind those of you who are already part of financial research about today's news. Today, we've shared an analysis that we've been working on for a while, which we were actually just talking about off mic, that you prepared together with one of our analysts, Mr. Kamikaze, working side by side, which is the thesis of one of the companies that's part of the model portfolio. We already did a deep dive on that sector, Sector 8, or as it's known, Valeris.
That's right, Antonio. In the end, it took a bit longer to come out than we expected for the reasons you mentioned, because the approach we wanted to take wasn't easy. You know, we're in the process of standardizing the ideas, and until now, each thesis had its own style, but from now on, they're all going to follow the same pattern, starting from the market and moving toward the specifics. Honestly, I think people have really liked it. All the feedback has been very, very positive. And now that we've got the hang of how to do it, things will move faster from here on out. The next thing is a report on the restaurant sector, which is almost ready. So we're going to start covering many more industries, and wherever there's value, that's where we'll be.
Fantastic. Well, Albert, as we say in today's headline, the Fed, just because the news was expected, or rather, just because the rate cut was anticipated. Yesterday it was confirmed. In fact, yesterday we did a live stream where Miguel Angel covered that part of the news, the 0 to 25 basis point rate cut by Powell. In my opinion, and I'll let you speak in a moment, it wasn't a particularly hawkish or bullish speech. Powell navigated things well behind the scenes. In fact, the market wasn't really sure which way to react, and I think that's a good example of that. That's just my opinion. You might have a different one. And now let's take a look. Yesterday, we looked at the macro point of view or the macro perspective, and now we're going to look a bit at the actionable perspective, meaning how this affects our portfolios and the followers who are watching us. Okay, so yesterday there was a 0.25 cut, but how does this affect me? How does this affect my portfolio?
Yes, exactly. I agree with you too, Antonio, that it wasn't clearly leaning toward a very dovish or very hawkish speech. It wasn't overly accommodative, but it wasn't overly aggressive either. For me, the key point wasn't so much the rate cut itself, which is fine, but it was already completely telegraphed. If I share my screen for a moment, you'll see that not only did they cut rates yesterday, as you know, when the Fed meets, they don't just raise or lower rates, etc., but they also prepare a series of economic projections and so on. So one of the key points is that they now expect the economy to actually grow faster. Here we have the projection from June. If you look, they were expecting 1.4% real growth for 2025, 1.6% for 2026, and 1.8% for 2027. And now they're expecting even higher growth. In terms of unemployment, they expect lower unemployment than before, and for inflation, they expect it to be slightly higher. So this is a scenario that's positive for many stocks. Inflation, a more inflationary scenario is bad for the economy, but good for the stock market short term. When interest rates rise, things change. We saw that in 2022. They're projecting a run-it-hot scenario where the economy grows in a slightly more inflationary environment. It's not out of control, so no need to worry we're going back to 7 to 8% like 2022. But this will help reduce the debt burden because if you have inflation and, on top of that, GDP grows faster, diluting the debt load. You know that it's usually expressed or measured in relation to GDP.
All right, well, there are a ton of questions, Albert. I think we can mix in some opinions, we can alternate questions, and if you're up for it, let's start with the hot topic of today, which also happened today. Pablo PCA, any thoughts on Nvidia entering Intel?
Yes, many similar news stories at Intel. I'll project it. We're going to
Show it. Take a look in the meantime. Well, I also have the investing screen here to share. Are you sharing it? All right, perfect. You know, a friend of mine, well, he doesn't really talk about the stock market much, but he works in the industry and knows a lot, told me when Trump came in, a good bet is Intel because it's going to be Trump's arm to make sure the US doesn't get left out of the chip game. They're going to put money into it, and Trump won't let it fail.
Honestly, I pretty much agree with your friend. Intel was a true giant, with almost 100% market share in the data center segment with its VAL chips. Since then, they've lost their edge. First it was AMD, before Nvidia really got into that area and so on, because let's remember that Nvidia initially made graphics cards, and that was pretty much where they were focused. Then it's true that their chips are also very useful, even though they're graphics cards, GPUs, for inference, training, and so on. In AI, they weren't a competitor in the data center segment. We see a company whose revenues have been flat for 10 years. In the last 3 years of the AI boom, where, with Oracle, we've seen a boom in CapEx, orders, and so on, their revenues are falling. Gross margins have dropped from 60 to 30%. They've been investing in R&D winking and laughing, over 15, 16, 17 billion, compared to what AMD has done is nothing. They're falling behind. So it's entered a really bad downward spiral. Several CEOs, even Pat Gelsinger, couldn't reverse the trend. What happened? Why has it bounced back so much? Fundamentals a mess, outlook, guidance, not better. Yeah, from lows, it went from 21, and today, not reflecting today's numbers, it was $30. So it's gone up a lot, almost 50%. First with the investment announced by the US government, and today with Nvidia's. And Mikey said, it has to do with the same thing we're seeing with critical minerals and mines. In the end, there's a kind of resource nationalism, and in this case, in order to compete with China, since we already know Intel also made a shift to have its own foundry, etc., and to diversify its options. It's a clear candidate for government funding. The technology is still far behind these competitors, but in any case, it's going to be used for other purposes. So the fundamentals are very bad. But Pablo, to answer your question, Nvidia's investment and the price dynamics are responding to other realities. In this case,
Let's take the opportunity to mention something, an important piece of news. Many of you signed up for the investing platform using the Locos to Wall Street referral code. You have it down in the description or in this QR code, and you get a 15% discount this summer. This summer, investing, which in this case is a partner of Locos de Wall Street, had a discount of up to 50% on the subscription. To that 50%, we added our 15% code, making it 65%. Well, from September 15th to 18th, as I said, you still have it available until today. They're back with discounts between 45% and 50%. Okay. So, for those of you who missed out this summer and didn't get the investing subscription, now might be a good time. You have until tonight to get that extra 15% off with the code LWWS, which means you could get up to 65% off on a platform that, as you can see here, we use ourselves and believe is really useful. Let's keep answering questions because look, Albert, you were just talking about this issue of resource nationalism and you mentioned rare earths. Alberto Jimenez asks, are you planning to analyze the mining industry specifically for rare earths?
We use rare earths as a single concept, but it includes many elements. Many are not investable because, for example, companies are in China, not public, private. Not all are viable. Limited auctions exist. Evident with the NP Materials case in the US, its surge. We can analyze it at a sector level, but it's not easy to generate investment ideas. The good thing is that it's not going to stop there. That is, there won't just be strategic investment in rare earths, but we're going to see resource nationalism spreading more and more and starting to include other industrial metals like aluminum, nickel, cobalt, which we've already seen announced, and so on. So there are going to be more opportunities in industries that we can actually get into. There are plenty of investment opportunities beyond just rare earths, let's say.
John Antonio Forcadell asks us, you haven't mentioned FRP Holdings yet, Nemantia's main position. The main one, I think it's one of them. I'm not sure if it's the main one. I'd be surprised if it were the main one.
I'm not sure if the main one was Brookfield.
Yeah. Or maybe now with Tesla's rise. I don't know. It's at a 5-year low and could be presenting an opportunity. You have it in the rot when you look at it.
No, I mean, I've heard Amerital mention it many times, but I don't really follow it that closely. It's true that,
Infrastructure-wise, it's not really like Brookfield, right?
although it's not, I don't see it at its lowest point. Well, maybe it's almost at its lowest, but it seems pretty flat, you know? I don't follow it enough to say, so I can't really help you, Joan.
Look, here it also says we have it around here, but I can't find it right now. Look, here it is, Oscar. As you can see, Grupo Galicia, thanks. Punished like everything Argentine.
Yeah, like everything in Argentina. Today it dropped sharply 7%. I see now, and if we look at the 1-year range, it went from 50, 80, and now it's at 29. It was at 50 a month ago. So, what happened? Obviously, the elections in Argentina. The market is punishing the possibility that Milei might not actually get a good result, that it could be impossible for him to govern during the time he has left, and that Peronism could also be on the rise. The bank is actually quite cheap, but obviously, if the whole trend that Milei is pushing, like tackling inflation, economic growth, currency liberalization, and so on, gets reversed, it would suffer a lot. So you don't look at a single company in the case of Grupo Galicia, but if we look at any other bank, such as BBVA Argentina, it's down 5. It was at 21 and now it's at 8, and in a month it's halved. They all move similarly. This is a macro trade, not micro. So in this case, the value will depend on the elections coming up in October and all the noise between now and then. If the polls start showing Milei gaining ground or showing him as more likely to win, then we'd see a rebound in the stocks. And if he ends up with a disastrous result, well, there's nothing more to say. Here I recommend you also check out Polyarket.Val. It's a website that's really useful. We used it during the US elections, if you remember, Antonio, and it's pretty handy because, look, let me project it in real time. It gives us an unbiased estimate because here people are actually betting their money. It's not like economic or political analysts who just give their opinion with nothing at stake, but this gives us a real-time opinion with quite a bit of liquidity about who the favorite is, by how much, and so on. So, Milei was a big favorite. Only a third of the seats are up for grabs in these elections. They're not playing for all seats, but the question was which party would win the majority. Milei was the favorite with an 80% chance, but after elections, that dropped to 58%. This uncertainty is what the market is pricing in. It's also about who will end up with the most seats after the elections. And here we see that if we look back, people already thought that Milei could even secure the majority, in other words, sweep the elections. This has been known for a while now. Since May, it's been suspected that this wouldn't happen, and now it seems almost certain. There's a 92% chance that Milei won't be the one to end up with the majority of seats. So what the market is now factoring in is this uncertainty, and just as the elections go, the country's stocks will move accordingly.
Personally, I'm not very optimistic. I've been burned by Buenos Aires before. I know Buenos Aires is a Peronist stronghold and all that, but I don't know. Right now I'm feeling a bit negative. I hope I'm wrong for the sake of Argentinians and those of us who believe in freedom, but I just don't know. But they were telling us that FRP Holding is now the second one. It seems that they've really had to expand because it's true that it's not a stock that has appreciated in value. Look, David, congratulations to Alver for your class yesterday in the Advanced Stock Market Investment course. Well, let me share an inside detail with you. Alver isn't very happy with the class yesterday.
I wrote to Antonio. I think it turned out a bit boring. It's true there were a lot of concepts to cover, but I'm glad, David, that at least someone liked it.
It wasn't a great class. The thing is, Alver is a really demanding guy, as you can probably already tell. Let me give you a bit of context. As part of the stock market investment training we do together with Tu Dinero Nunca Duerme, we wanted to have a class on valuation fundamentals. That is, how to do a rough valuation, a valuation where we do a discounted cash flow analysis and, in the span of about 2 or 3 hours, get an initial valuation that can already help us decide whether to spend more time on it or to rule it out, which is also very important. In the end, time is limited, and Alver explained how discounted cash flow and WACC work, how to calculate the present value of a company. Well, honestly, it was really good. There's a second part to the class, right? And we're going to enjoy it because you gave the students some homework, didn't you?
Yes, exactly. In the second part, we'll really see how to build a model like this from scratch, where to find the information, what to focus on, and so on. And then we'll give them some homework to actually do it. In the end, you learn by doing.
Absolutely. Look, speaking precisely about what you're looking for with evaluation, which is to calculate the intrinsic value, here, without wanting to stir up controversy, Pablo Salgado asks us, what do you think is the intrinsic value of Nagarro? Well, it's definitely getting closer every day to being within reach, because honestly, what a streak it's been on.
Yeah, This company hasn't really taken off recently. 2021 wasn't great, even though tech and this business were all the rage. The stock even traded at $200, if I recall, which is insane, and now it's $50. Fundamentals, revenues, continue to grow, but margins have taken a hit, right? It's a company whose margins have dropped from 25% to 21%, which is quite a lot. Costs have also been going up, which is actually pretty normal here. I mean, it's not surprising. And then what's interesting and always important to consider when valuing it is one of the things that's always been questioned about Nagarro, because it has accounting practices with factoring and so on, which aren't so straightforward from a cash flow perspective. So let's say its working capital doesn't help it at all, and it's a company that, because of how it operates, generates little cash, or let's say it's hard for it to generate real cash flow, and that's what the market penalizes, in addition to the industry being weak and growth having slowed down a lot. As we saw here in the income statement, revenue growth was projected at 20% in 2021 and 2022, which was spectacular, and now it's dropped to less than 10%. The market punishes this. It's not the same for a billion-dollar company as for a $500 million one. The recession is industry-wide, not just Nagarro's. Globin and Deva are all in the same situation. It seemed like these projects were recession-proof, crisis-proof, because digitalization was key, and now they've taken a backseat with topics like AI and so on, and honestly, companies are suffering.
All right, let's do an exercise. How many watching are subscribers to Financial Research? Because the other day, on Monday, we did a live stream for subscribers with Edgar. Those who attended saw that Edgar, who sometimes the audience doesn't want him to hold back, gave his opinion, shared his view on Nagarro for subscribers. Someone should put it in the chat. Honestly, it cracks me up. By the way, to tie this in, Raul, I think Edgar actually has it in his portfolio. We prefer not to comment on it because, as you know, he doesn't want to talk about positions in his portfolio. So, we're not going to discuss this position. In fact, for subscribers, he was talking about it for a while last Monday and even answered questions about this company, so we'll leave it at that. I wanted to.
Before moving to Antonio, since we were asked about Nagarro's value and don't follow it closely enough to make projections, but one interesting thing about investing, especially the pro version, is it gives us projections based on analysts' opinions and turns into a model. So notice that the revenue growth projected for this company is 5% for the coming years, and with that, it tells us that the estimated fair value is €91, which would actually leave a pretty interesting upside. Here we see the discount rate applied, and depending on the discount used, its potential worth. They also provide calculations for each line of free cash flow generated, its growth, and so on. So if you think that revenues are going to grow more than this, you can see it, right? You can see that they even estimate the free cash flow will stagnate and not grow at all. If you have a different opinion, then that could be an opportunity to go long or short, to say, hey, I'll avoid it because I think this is too optimistic or not, etc. So it's always interesting to see what the projections are and what they would give us in terms of a fair value.
We had a question here from Alberto Jimenez, who was asking if you've ever analyzed Carvana and what your opinion is of it. Well, as for me, I'm not really familiar with it, Albert, and I don't think you are either. But in the last Sanhedrin, if you saw it, I analyzed the case of Open, a company that's also one of the most traded, with options and tons of discussion about it on Reddit and so on. And all of this is driven by the same hedge fund manager, a guy named Jackson, who became famous for specializing in, let's call it, turnaround operations for companies that are in the middle of restructuring. He invested in Carvana right when it was practically on the verge of bankruptcy, and well, he's made an insane return. So you could say he specialized in that kind of company, and now he's super bullish because he thinks the same thing is going to happen with Open. If you didn't catch the Sanhedrin, well, Open is basically a business model that's already had some attempts in the US, even though it hasn't really taken off. It's basically about selling your house online instantly. So if you know Carvana's business model, it's similar. It's about buying and selling your car with just a click, with the peace of mind that you won't run into any hidden issues with the car, and so on. Well, Open is a business, obviously with a lot of differences, but with homes, where it's true that there hasn't been much disruption in the last 30, 40, 50 years, so let's see what happens. Albert, I don't know if you knew about this, if you saw Sanhedrin the other day in the case of Open.
Yes, and actually, I also saw a manager comment on it. I mean, he had 300 or 200 shares, right?
Right?
Yes, we've shown it. He had it, it dropped 99%. This traded at bankruptcy, you can see from over 300 to 4, and now it's gone up 100-fold. Yeah, that's a wild ride, gut-wrenching ones. I'm very critical of this company. I think it's a business model that only works in the times we're living in right now. We've seen it with zero interest rates. It worked when these companies generated a lot of buzz, etc. The insiders are the ones getting rich, both with stock options, selling shares, and so on. And honestly, I don't like it at all from a fundamental point of view. That said, obviously, whoever got in, like you said, Antonio, as a turnaround play when this was trading at rock bottom, must be very happy because they've made a huge return in just 2 years.
Well, we have a lot of subscribers, and I also want to take this opportunity to say, as I always do, that many of you are joining Locos to Wall Street after seeing us. We often mention financial research, where we've presented the Valeris model, and so on. After seeing what financial research is, the service where you, let's say, lead everything on Discord, the model portfolio, and so on, tell us about it.
Well, it's the guide we have at Locos de Wall Street for investors. We know it's a competitive industry where institutions have access to information, resources that retail investors don't. It's hard to distinguish noise and signal. We're seeing news all day. If you're plugged into Twitter, Reuters, Wall Street Journal, even Expansion, there's noise. Separating signal from noise, applying an investment philosophy to find opportunities, discussing them, figuring out interesting ones, many times, due to time, ability, resources, it's out of reach for retail investors. And what we do is all that analysis work, sharing data, providing access to resources, tackling impossible reforms, and then putting all of that into, as I said, a sector selection, and so on in a model portfolio that aims to illustrate this way of working, and so forth. And that's what we do.
Edgar was saying the other day, specifically in this private closed session with subscribers, that the quality standard we're aiming for is quite high, and that's why, well, you know, Edgar is especially passionate. I crack up at his comments because he has the subtlety of sandpaper, but he was saying that the analyses you're going to see, or are already seeing, with all due respect, don't have much in common with a lot of Substack and so on, which is basically a bit of ChatGPT with investor relations and such. Here you have the PDF we shared today about Valeris. As you can imagine, I'm going to go through this really fast because this is gold for the subscribers. but what you've been seeing these past months is 30 pages of pure value, okay? Like I said, I'll wrap this up quickly because this is for subscribers, and I really think it's worth it. So, for everyone who's interested, you know what to do. We welcome you, and I'm glad to see more and more of us joining in. Jose Luis Rodriguez, gold. There's been a lot of talk about gold lately. What do you think about the GDX ETF as a way to get exposure to gold? How could tomorrow's rebalancing affect the mining index, with companies coming in and out?
The mining companies that arrive on the first day will see a good flow of capital. New additions are already bought or anticipated, but the ones that will be removed see a drop on the first day. This creates opportunities if you like the project, and there's no problem. They recover in days, and the volume gets absorbed. The ETF is a very good vehicle, not a recommendation to buy or sell, but it's a good way to get exposure if you're not a specialist. Why? It gives you exposure to gold or companies leveraged to it, like mining companies, but you avoid risk. It won't be the top performer. Pick a good junior or better company, you'll make more. But it does give you exposure without having to, quote unquote, do as much due diligence as you would with individual companies. So you dilute the risk and also the potential, but it lets you play it from a macro perspective if you're bullish without having to get so much into the micro.
There are more questions here. Morrow is asking if you still have Australian companies on your radar. He's asking about Mother Group, Duratec.
Yes, in fact, Duratec is a company that was in our model portfolio. It did very well, and actually now it's even higher than when we sold it. You know that we often don't catch either the absolute low or the absolute high. We got a very good return. I don't remember if it was in 3 or 4 months or maybe a bit more, but 30-something% is a very good result for a company. And we exited because the future return potential seemed lower compared to what we replaced it with, but definitely not because it was a bad company. And I really like Mother as well, but the thing is, it has always seemed more expensive to me. As you know, I have that flaw. I tend to be demanding about things being cheap, and that kept us away. But they are very interesting companies, and they have many tailwinds. For example, Duratec, infrastructure aging, defense interesting. So it has exposure to many industries with strong tailwinds.
Albert, I don't know if you want to start selecting because you're not.
Showing them to me, it's fine, no problem.
All right, Pablo Salgado is asking us how we see the recent drops in Constellation software. It's an entry window. Honestly, it caught my attention. It's a company that, well, I think anyone who's been investing for about 10 years or more, like me, sees it as one of those errors of omission. Obviously, you can't hit them all, but the truth is it's been struggling for a few months now. I don't know if you have it up there, Albert.
Yes, do you want me to share? Okay,
Yeah, I just put your screen up. If you type in CS, that's the ticker.
it's dropped about 20% or so from its highs, but as you can see, it's nothing too serious. If we look a bit further, over 5 years or even just 1 year, it's basically flat, okay? It's not ideal, because we're used to more from Constellation, and a 20% drop from the highs isn't small. There have been very few times in its history when it has dropped by 20%, and that's why, in the comments they've made, people are worried about whether their business model, which, as you know, is based on buying lots of small companies, usually ones with niche software, can still be a winner or if it might become a loser in the age of AI. People are wondering if this model can keep working, or if AI will dilute their opportunities, or if some of their software will be replaced because it's much easier to replicate with AI, and so on. So all those doubts that I don't. Predicting where AI will end up, especially in such an early stage, is difficult. but the market is factoring this in, and it dropped 20%. A successful business model now faces the possibility it might not be replicable or scalable in the future.
Pablo also asked us if you've looked into Sky Harbour and Charter Group.
No, Sky Harbour a bit more. I think we talked about it last time, or I don't know if it rings a bell for you, Antonio, because
It sounds familiar. Sky Harbour or Sky Harbour is from Emerito, right? Vin is running.
yeah, I clearly remember. Yes, it's the one with the luxury airplane hangars. I searched for Sky Harbour and found nothing. I know it through them, but I don't follow it much. Chapters will about. I don't know if you follow it, Antonio, but
No. No, I don't.
follow it.
Look, Pablo Postigo is also asking you. This is the fund I can never remember. Well, I don't know if it's actually a fund or more like a research house.
Bit.
A fund? Pablo, what is the historical return of Gavin Rosabike fund? How reliable are their theses? If all of them were as clear as they say, they wouldn't have achieved such an impressive return.
Yes, and I agree with you that you should take it with skepticism because they've had good returns, and I think they're around 17 or 18% annualized. Obviously, it's not what you might expect if they had knocked it out of the park every time, like you said, right? If everything had been 100% and so on. But it's a very decent return. Very few people have a 17 or 18% annualized return over the long term, especially in a niche fund, let's say, that focuses on just one thing, which is commodities. But we don't follow them or analyze them just because their investment ideas are better or worse, right? You can have a good macro idea and solid research, but not know how to make it actionable or pick the best option. So, what interests us? Their contrarian approach to data. In the end, it's about taking the real information, whether it goes with or against the consensus, analyzing it, seeing how it fits, and then figuring out how that can be translated. So I think they haven't always been the best stock pickers. One example is with natural gas. The companies they've chosen to play, in my opinion, aren't the most interesting, and other times they've arrived too early. So, these two things worked against them, but even so, they've managed a good return. Their research is reliable, and picks depend on your style. Analyze them yourself. But as for the research, are they reliable?
Them, they always say they are. They prefer. I'm not sure how to put it. They tend to get into things way too early. And in the end, according to their theory, it doesn't really move the needle when the idea finally takes off, right?
Yes, that's it. I've also picked up this question from Jose Luis, who asks, what do you think about playing in mode with medium-term calls? The cash they have is tremendous. So, what problems are there? First, in a recession or consumer crisis, they suffer a lot. These are non-invasive cosmetic procedures, very expensive, 3 or 4,000 euros per procedure in many cases. So, a company that was growing a lot and has now stopped growing is facing, as I said, a consumer recession. You can see here the growth rates they used to have and the growth rates they have now. When this happens, the market really punishes the multiples. On top of that, high or relatively high interest rates hurt them because many of their sales are made through leasing. So when interest rates are high, the reference rates for the latest leasing deals are also high, and that hurts them. So the cash they have allocated properly, that is, management were willing to carry out massive buybacks, would be very useful and maintain valuation or make rise significantly. Since they're not, that's why I'd say it's not that interesting, but if you have to play it somehow, medium-term calls, and especially a bit longer term, if you believe the consumer will eventually recover, well, the company is very high quality.
Gustavo Garcia asks us about Bitcoin miners, specifically Bit. Is now the time to get out? Well, I don't know if it's time to get out, but whenever we talk about Bitcoin, that song Wake Me Up When September Ends comes to mind. Because now, according to those who believe in Bitcoin seasonality, the sweet spot is coming, right?
Yes, the problem they have is that it's a business model that's going to get worse. And let me explain very simply, you'll understand. The mining companies that performed best, we discussed and invested in quite a bit in research and tunnel, if you remember, like iron, cores, etc., have done well because they've dedicated part of their capacity to data centers and computing. That's worked out really well. So, what's the problem with Bitcoin mining? There's this thing called the halving. The rewards get cut in half. So, in a world where the hash rate keeps going up, in other words, there's more and more competition, and when you actually succeed or solve the validation, the mining reward gets cut in half. You're going to see your margins shrink. Unless the price makes up for it by a lot, your margins will keep getting smaller, especially with the current market cap. And I'm actually very bullish on Bitcoin, so don't think that. I'm not saying this from a bearish perspective on the asset. Normally, returns tend to decrease with each cycle. It's true that with institutional adoption, the drops might not be as steep, but in any case, returns are still going to decrease. Bitcoin mining companies do well in the first phase of bullish movement because they offer beta leverage to rise. But now we're in a phase where we see increases or upward consolidation. It's rising slowly. They don't perform as well. So I don't know if they're going to continue rising as obviously. I wish I knew, and I don't know Vic specifically, but I would tell you that if you like this industry, look at those that are also oriented towards other narratives and other types of more scalable business models now and that have good prospects.
Seeing this, it wouldn't be a clinic if we didn't ask you about it today. Danny Sanchez. Hello, Albert. How do you see Cosmos? Will there be new updates this year?
Yes, new updates are coming. We'll see GTA's part with Golar scale up. This is already working and ramping up, and we'll see it this third quarter. They've also carried out drilling campaigns that will greatly improve the Jubilee field, which has been affecting today's production. This will come into play in the third and fourth quarters. So the big unknown is what the oil price will do, which we don't know. I'm more bullish than the consensus, but of course, that's the main variable. It doesn't need to go up much. As long as it stays around 70, for me, Cosmos is already going to do very well.
That's what I was going to say. You've mentioned on other occasions about Cosmos that it's basically a standard, that Cosmos doesn't need the price to go up, just that it doesn't drop any further. I mean today's price.
Yes, exactly. Obviously, if it goes up, that's much better, but it's not necessary.
Let's continue with commodities. Namaste to 9. What do you think about Rio Tinto? What entry price would you find interesting?
I don't follow it to give an entry price. I don't follow it, but I know the company and keep an eye on it. What's the problem with these big mining companies? The problem is it's not a directional bet on anything. Parts of their business weigh more heavily. We can see it in the ADR. We could also look at it in the UK, but anyway, it doesn't matter. It's a company with exposure. It's a giant mining company that has exposure to many commodities. So, what's the issue? That's both good and bad. Obviously, it's much more stable. We can already see that the revenues aren't what you'd expect from a typical cyclical company. You see that with ups and downs, but overall it's reasonably stable and growing. But in exchange, it's never going to give you the operating leverage you're looking for with exposure to certain specific metals. I don't like it as much, but it's not a bad company. If you have to own a mining company throughout the whole cycle, it's not a bad option either. It's not going to give you leverage, but it will give you good dividends. in the long run, it's going to build value, as we can see, which isn't typical for a cyclical company.
346 people. Right now, we're on Twitch, Twitter, and YouTube. You know, we really appreciate you liking, subscribing if you haven't already, retweeting, etc., etc. It helps us a lot to continue growing the channel. Joseph Font, do you follow GIs? What do you think? Long term?
Yes, I follow the consumer side of things a lot. Okay, company,
Skis. I didn't get it at first, sorry.
General Mills.
Right, sorry.
So it's a company that has some debt and it's facing a consumption problem. Here we see the revenue growth. These middle years are due to inflation, so that doesn't really count. In terms of volume, it's still declining, but it has good brands, a reasonably good margin, and it's not expensive. Okay, but consumption is what it is, and the deck is high for me. The valuation isn't a bargain. It's not expensive, but it's not a steal. So when it comes to consumer companies, I prefer others, Kraft, which I like more than General Mills, and I don't like Kraft.
Vichit is asking us about the company Nebius. Do you guys find this one interesting? I think it's gone up a lot in the last week because of a deal with Microsoft, if I'm not mistaken. The ticker is NBIS, right?
Here you can see it. This is a company that has obviously grown thanks to the AI boom. It's got the chips, data centers, and so on. So right now, it's what's trending. It's a company that doesn't make any fundamental sense. If anyone takes a look at this, they'll see it's crap, honestly. But what's the catch? That this could. It has the potential to scale a lot if AI really keeps booming, if the demand for it keeps growing, and so on. Right now, it moves not because of fundamentals, but because of news. If you know how to play the cycle and take advantage of it, that's great, but it's not a company that fundamentally makes any sense in terms of profits, etc. What you're playing is a narrative, and obviously it's worked really well. We can see it here, not everything about AI, but specifically with NIAS. And that's the story it has, yes.
Here's Jorge Vinales asking how you take beta into account when building a portfolio, over what time frame, and how you integrate options into that risk management. Well, Albert, this calls for a talk from you about portfolio management. This is by popular demand, kind of. We're actually working on the portfolio right now.
Yes. And we also have it in Logos.AX. And I'll take this opportunity to answer both this question and another one we've been asked. Okay, Antonio? They're kind of related. Someone asked if the live sessions we do for subscribers are recorded on the platform, and if so, whether they can watch them if they subscribe, which is a reasonable question. So, project. One moment. Yes, they are recorded. We have a section on the website for videos. You can see Q&A, a session with Edgar, Altlock Consults are done, live sessions with subscribers on investment philosophy and portfolio management.
Help.
If you subscribe, you can watch it. Exactly. And how do I manage this? Well, look, I don't really take beta into account. That's not something I worry about much, but risk management is definitely key for me, and I handle that more through position sizing and leverage. Not using leverage in times like these, that's crucial. Options as well, really limiting your exposure through puts, etc. And yes, I do manage position sizes a lot, but not so much measuring beta itself. You can see that many of our stocks, like ACC or Cosmos and so on, have a huge beta.
What I say here is, when you see that there are two sources of returns for a manager or investor, one is idea selection, meaning finding good ideas, and two, you can find really good ideas, But if you exit too early, enter too late, or insist on your mistakes. In this case, Albert has timing. I was about to say something rude, but honestly, he really does have great timing. He's a very good manager. He's a very good manager when it comes to knowing when to sell, close out here, cover myself, and so on. We've already done a few where we're both bullish, and I always see you, for example, selling calls every time the company goes up, and I think, damn, and you get it right. Then it drops, and you keep all the premium. We're not going to name the sin. Okay, let's name the sinner, but not the sin. A company. All right, let's go with another one, which is Braskem. It wouldn't be a Q&A, a session if Braskem didn't come up.
That's right. Well, it's offering an opportunity right now. Yes, the petrochemical cycle is in a bad phase. We saw it with LyondellBasell, Dow, and others. It's been hit much harder, also because it's a worse company with other problems, both cyclical and related to the geological event in Alagoas. So it carries a much higher risk. It's offering an opportunity in profitability, but you must know you're taking on a bigger risk. How do I see it? Even tariffs, anti-dumping measures will help, the cycle will turn, but it's in a delicate financial situation. So the risk you're taking on is also higher. Oh, sorry.
I had.
Said.
Yes, I brought that up precisely to tie it in with the title of the show as well, which is what do we think about the TLT for the coming years with the rate cuts? It's not that easy to play, and you guys are.
Yes, when rates were going up, it was very easy to play this and take advantage. But when rates are coming down, it's not going to be the same. If you want, Antonio, you can also explain how you see it in the end.
The TLT is ultimately just a mechanism that also includes the various portfolios of long-term U.S. Treasury bonds. They pay out dividends. At the end of the day, it's an ETF where every month that the thesis of rate cuts doesn't play out, it wears you down. So it's not just that, but the rate cut itself is also being priced in. So what would need to happen for you to make money with TLT? Not only would rates have to go down, but they'd have to drop faster and more aggressively than what is currently expected and what is likely to happen. For example, yesterday Powell would have had to cut rates. Then you would have seen a bit of movement.
That's right. The speed and magnitude are key.
You guys have some fantastic nicknames. The Sideburns guy. What do you think about Evolution AB after the drop, which was mainly due to legal issues? There seem to be a lot of clouds gathering over this company. Don't you think?
Yes, I especially like it. I like it a lot. I think it's an extremely high quality company at a very reasonable valuation. Obviously, it's having a lot of problems, like a slowdown that's partly intentional because they're focusing on regulated markets and partly unexpected due to what you mentioned about legal issues, the piracy they're facing in Asia, etc. So, for me, it's reasonably priced. It's a very high quality company, and a lot of the legal problems they have just seem like noise to me. That said, obviously what the market is punishing is also the slowdown in growth, and it's making that clear. But I really like it.
It's Evolution here on investing. It's this one that shows up here. I don't know which of the two it is.
Let me check. I'll look it up too. Okay, look, you have to search for Evolution AB, and it's the one that says O and EVO underneath.
This one. Ah, this one. 809 SEK. Here we have it. Yes. Well, it's listed on several markets and all that. But normally this is a Swedish company. So it's on the Scandinavian market. Yep, here it is. More. David, let's get back to interest rates. With the expectations of rate cuts in the United States, an insurance company fund, specifically Polar Capital Global Insurance, has started to fall. What can we expect from the sector?
Well, logically, that it has dropped. In the end, you already know how insurance companies work, and they benefit a lot from being able to invest in bonds with high yields. In fact, they've struggled when bonds were yielding very little because what they do is collect premiums, invest them, and then cover certain payouts. Eventually, the more return they get from what they can invest in, which isn't much really, and bonds are one of those things, the worse it is. So it's not a business that's going to benefit excessively. Obviously, in this environment, it might make sense because of other tailwinds, like the company's own efficiency and so on. But anyway, it's a sector that's not going to have a great time. A sector that's not going to have a very good time.
Oh, look, Mark Garcia, you mentioned it there. Does the price for Resior stay fixed or does it go up? Yes, the price does go up. Well, as we've mentioned several times, we're in a period where the price is going to increase. We don't know exactly when, but it's likely to go up before the end of the year. And indeed, whoever buys now and locks in the price will have it fixed for life. Right now, if you sign up for the annual plan, it's 41 euros per month, taxes included, which means it would actually be quite a bit less. A lot of you even ask us, hey, I'm a business and so on. Do you issue invoices and all that? So if you do the math, it's much less. And as long as you stay subscribed, you keep getting your money's worth, literally. Because just like with any subscription service, right now we have over 1,000 subscribers. But of course, we also have cancellations. Do you know what the main reason for cancellations is? And it's something we know, we accept it, but we're not going to change it. There's just so much content, it overwhelms me.
Yeah.
Portfolio, Discord model, reports, videos. And I always say the same thing. Look, this is like someone signing up for a library. Or better yet, it's like an AOI saying, this is like canceling Netflix just because you can't watch every single show. Come on, the more options you have, the better. Just stick with what you like, right? But that's how it is, I get it.
Some people lack time or dedication, and I get that. But as you said, there's no obligation to keep up.
In fact, we put a condensed version. By following the monthly live sessions, you get much from it, which is only an hour monthly, so it's not much.
I've got my investor hat on, and a lot of times Albert knows I even ask him things in private and all that. And really, just by following the Discord channels that interest you, with notifications turned on so you get alerts. There's no noise there, and keeping an eye on the posts, which are at most once a week, that's more than enough even if you don't have much time. And for those who already have it, well, Disneyland, Vysen, which sector do you see benefiting the most from the interest rate cuts? And also taking into account the season we're about to enter. I mean, we're heading into Christmas and there's another interest rate cut. Which company? Oh, you cut out there, Vysen. Yesterday it wasn't clear. Albert, I don't know if you saw it. Do we have 3 more rate cuts left or just 2? That's kind of what I didn't quite get to.
There's uncertainty. If I had to bet, 2 more, October and December.
Which one would it be in theory?
These aren't the kind of rate cuts because, like Antonio says, for now, the cuts aren't going to be that big or that fast in terms of magnitude and speed.
What I can tell you is that we're probably going to keep seeing dollar weakness like we are now. So things that benefit directly from this are precious metals, commodities, and so on, emerging markets, etc. So when it comes to emerging markets, I'd say that even without getting too deep into raw materials and so on, they can benefit pretty easily.
Terraformigita, do you think that generally, in the first days before expiration, Monday and Tuesday of next week, are good days for selling options when volatility is high? Unless I'm mistaken, I haven't noticed that there's more volatility at the beginning of the week. I actually think there's more volatility on Fridays at the end of the week. I'm not sure if you mentioned Monday and Tuesday because of some specific effect. Maybe some macro effect or something like that. But unless I'm mistaken, for example, tomorrow is the 19th, which is the third Friday of the month, the main expiration date. Tomorrow is usually a day with a lot of volatility in the options world.
I left it to you, Antonio, since you're the one who knows the most about this.
Honestly, Alvaro Torres, any opinions on Barrick, specifically about Fernill's expectations?
Well, about Barrick I can tell you, but as for Formail's expectations, I can't. I don't follow them that closely, and out of the major companies, Barrick isn't my favorite. I prefer Agnico Eagle Mines 100 times over if you want to play gold in a somewhat conservative way but still have exposure, etc. It's perfect for that, but there are better options. I'm talking about this one. It dilutes both your risk and your potential, so I couldn't really say about that. Yes.
We're going to move on. Please excuse us if some questions end up not being answered. Honestly, this live session has been really productive because we're answering topics pretty quickly. What do you think about Him's trading with Carlos? Well, Him's had a sharp drop this week, but unless I'm mistaken, today the stock is going up. In my opinion, this week's drop was a bit strange because it was basically due to the FDA, the US Health Regulatory Agency, giving them a sort of warning, saying they might be engaging in misleading advertising for their GLP-1. I've already mentioned this in the Sanhedrin, that for me, GMS was skirting the line ethically with what they could say about the GLP-1 weight loss drug. While it's true that people expected the FDA's decision, that FDA statement, to be much tougher, and to put it in terms we all understand, when they thought it was going to give him a real wake-up call, it ended up being more like a nun's pinch, just a gentle little warning. And well, like with everything, it depends on who you ask in the company. There were people yesterday saying it wasn't negative at all, because as I said, the punishment could have been much worse. And in fact, implicitly what it should be saying is, hey, you can keep advertising GLP-1, but do it properly. That's what the bullish thesis has latched onto. So yeah, it's a company with a lot of volatility. For me, it's a company where lately the CEO has done things I don't like. But it's also true that the numbers speak for themselves. We'll have to keep a close eye on it because the growth is incredible. I've never asked you what you think about Heinen's, Albert. I know it's not really your area of expertise, and you usually don't like it.
No, and I see it. I mean, I think their business model is truly disruptive and transformative, but I always see them walking a razor's edge. So I do see that, and they operate on a very fine line between what's allowed and what's not, as we're seeing now, so it's just not my thing.
Albert, someone is asking, what do you think about long-term puts on the S&P 500 and Nasdaq? This is actually something we've also been discussing in research.
Yes. Well, I think they're reasonable because right now we're at pretty demanding valuation highs with relatively low volatility for puts, meaning that hedging isn't expensive. And as the saying goes, you buy insurance not when you need it, but when you can't. So if someone really wants to set up a hedge, it's a reasonable time to do it. Does this mean that it's definitely going to fall or crash, etc.? Not necessarily, but if someone is looking for this, now is the time. If you do it as a strategy to systematically bet against the market, I'd say that's foolish because companies, the stock market, etc., are designed to go up. In the end, simply due to the devaluation of money over time, profits, and so on will rise. So if you look at the long term, it doesn't make sense to be bearish over a 10-year horizon. If it's as a hedging tactic, then it makes sense.
Look, speaking of hedging tactics, Willard also asks us, sending him a greeting as well, premium user. How do you see playing the Argentine elections with a purchase of both a put and a call, for example, in Grupo Galicia? Well, yes, that could work perfectly fine. Look, what's clear is that there's going to be a lot of volatility before the elections, and when the elections happen, there will be an effect known as a volatility crash. That is, when there's an event that generates a lot of volatility, no matter which side ends up winning. There's a typical strategy, which is exactly the one you mentioned. That's the reverse of the iron condor, where you lose if, in the end, the price stays put. Imagine that Grupo Galicia is trading around $30 on election day. Where would you lose? You would lose if Grupo Galicia stays trading around 33 to 27, in a range relatively close to the current price. You'd make a good profit if Grupo Galicia jumps to 40 or 50 because, say, Milei wins and comes out stronger, or if Grupo Galicia drops to around 10 in December because Milei doesn't win and the company is negatively affected. This is a typical strategy in these cases, Willard, and it's very well regarded.
That's why.
And we also have a question. Look, this company is in oil, and I don't know if it's come up much before. What is Tullow Oil?
Honestly, I don't like it at all. It's the counterpart to Kosmos in the Jubilee segment, and in fact, there was speculation that Kosmos might even take over Tullow Oil entirely. It's a company that has never been well managed. It also has a lot of problems with its balance sheet, etc. In fact, AZ, a fund that you know is also specialized in commodities and all that, was one of its biggest bets in 2021, 22, and so on. Even before that, actually, and it hasn't worked out well at all, especially compared to others. So overall, it's a company I really don't like at all. If they manage to turn everything around, obviously the potential could be huge because the company is valued very low for the quality of assets it could have. But for me, the risk just isn't worth the reward when there are other options.
Hey guys, if you agree, let's answer the questions we have here. Let's stop accepting more so we don't drag this out too much. Also, I don't know how many questions we've answered so far. I feel like it's quite a few. Today we've broken the record, 30 or 40. We're going to finish earlier today. Let me just remind you of what I mentioned throughout the show. You already know that with the code we have, the link in the video description, or the QR code I'm showing on screen, depending on how you're watching us. If you're listening to the podcast, if you're watching us on YouTube, on Investing Proc, on the platform we're using, you always get an extra discount, always at the best price the platform offers, of 15% with the code LWSWS. But right now, they're in a 3-day promotional period where they're offering the same price as Investing's summer sale, which lasted until August 31st. And as you know, that's a 50% discount. 50 plus 15 from Wall Street Madness. 65 if you were thinking about it. Well, we're glad to have a partner of Investing's quality, and that's why we're sharing this code. Jose Carlos says, "Hi guys, I followed the Wall Speed situation. This is another mining company, right? I think this one even. I think it's even. Let Jose Carlo tell us in the chat. I think it was one of those that at the time I don't know if this super investor had or has. Rick. No. It's just that Edgar likes it a lot. It's Drake and Miller. Drake and Mer. Let Jose Carlos say it, because if he says it, it sounds to me like this could be it. Let him comment on it. Look, Beto from Monaco left us this question at the beginning, as he can make it to the live show. I don't know if the VOCC rates are already reflected in the stock prices. It's getting interesting.
It depends on how long they last in the end, obviously, because tanker companies with exposure to VLCCs like Okeanis, DHT, etc., are at 5-year or even 10-year highs in the case of DHT, historic highs, really, and in the case of Okeanis, it's still got a little way to go. But anyway, in any case, if this continues over time and drags on, it wouldn't be fully priced in. And now we're coming into a positive seasonal period, right? You already know that, but you have to look at it. At the end of the day, there are two variables. The first is OPEC exports and so on, which is great, and then whether oil demand holds up. If you're bullish on that, then it's still not fully priced in yet.
Roten asks us if it makes sense for a company that had a hostile takeover bid to be trading at a higher price now, if the buyer withdraws the bid and the company drops. It was almost impossible. He's talking about SKYH in this case.
I don't know the company, but it generally doesn't make sense. If it was trading way below and the takeover bid falls through, for it to keep going up after that. Unless it unlocked some value or the takeover bid highlighted something the market hadn't seen. I don't know this company, so I can't judge it, but when takeover bids fall through, the opposite happens.
Jav, how do you see the stablecoin sector?
I'm bullish. I think this will grow a lot. What doesn't make sense are central bank digital currencies like the digital euro, etc. That makes no sense. They're trying to compete in a space where everything has been invented when it comes to stablecoins. We have to be clear, we think from the perspective of Europe, the United States, and so on. But just imagine being in a country where you don't have access to dollars and you can do it through stablecoins. You can save there, exchange it, send it without barriers, etc. So these are things that make a lot of sense. And then to build on top of that in terms of technology, too, I'm very bullish on that part and on how much it's going to grow.
Alberto Jimenez, lately, I've been really focused on cybersecurity companies looking toward the immediate future. As you can see, I think a specific ETF has a lot of potential.
Yes, cybersecurity has potential. What I can't say at what valuations you'll find them. I was following, besides Fortinet, Palo Alto. They were expensive, but I don't know if you're an expert and know more, so it makes a lot of sense from a fundamental point of view, and maybe the tailwinds are priced into the valuation.
Fantastic. So we've reached the end of Q&A session number 8. We've broken all the records. We've answered a ton of questions, as always. I hope it's useful for you. And remember, if you're left wanting more, you have the research. And if you also want to take advantage of the Investing Pro offer, we've left the code and referral link in the video description. Albert, thank you so much.
No problem, Antonio, and to everyone who's been listening to us.
All right then, have a great start to your weekend, Wall Street fanatics. Not for tomorrow, Friday, but this Friday of the month, Manu Rajano will be here to talk to us about the witching hour for options traders. Sunday is Sanhedrin, and this just keeps on going. We keep going. A big hug to everyone. Bye.